All right, let's talk about Kraken Robotics, because they just pulled off a move that has completely shaken up their stock. If you've been watching the market, you know everyone is scrambling to make sense of the new numbers right now. We're looking at the recent closing of the massive Covelya acquisition. Literally overnight, this deal has fundamentally rewritten Kraken's financial reality. It's triggered some really intense selling pressure, but at the same time, it's setting up some massive forward guidance. So today, in this explainer, we are going to break down exactly what this re-rate means for the company's valuation, how the dilution actually impacts the bottom line, and where the stock could realistically head from here based on the cold, hard math. Let's get right into it.
Okay, let's dive into this. Here's our roadmap for today. We'll unpack the Covelya acquisition drama, do the actual financial math, check the valuation multiples, walk through 4 future stock scenarios, and then zoom out to look at the big macro picture.
Section 1. The Covelya acquisition drama and dealing with dilution and underwater investors. Right now, this share dilution is the exact friction point driving all the market anxiety. Before this deal even officially closed, astute market watchers were already modeling a potential drop. There was a very clear bear case prediction floating around in a recent Substack analysis. It basically said that dilution shares would cause selling pressure immediately after the Covelya close, essentially sticking the stock firmly in the 6 to 7 Canadian dollar range by the end of the year. And, well, sure enough, that is exactly where we find ourselves today. From trading around $6.96 just a couple of months ago, we recently saw the stock drop down to $6.37. But we really need to ask, why exactly is this specific drop happening right now?
Well, that brings us to this absolutely staggering number, $47.35 million. To actually fund this deal, Kraken had to sell millions of what are called subscription receipts. If you're not familiar, these are basically just placeholders that convert into actual shares once a deal officially closes. So, they raised a massive $402.5 million, selling these receipts at $8.50 a pop. But here's the psychology behind what's happening now. Those receipts have now converted to real, tradable shares. With the stock currently trading down near $6.37, every single one of those new holders is sitting significantly underwater. And as you can imagine, that creates a massive overhang of selling pressure, because some of those investors are inevitably going to rush to dump their shares just to cut their losses and stop the bleeding.
Moving on to Section 2. Doing the financial math, fear versus the new reality.
If you're currently holding this stock, this is the burning question that's probably keeping you up at night. Because of this new share issuance, do I now own 20% less of the business than I did yesterday? Look, it's a completely fair question. The share count just ballooned from 321 million up to 385 million. So on paper, yeah, your slice of the pie just got visibly thinner. But as we know in finance, you can't just look at the size of your slice. You really have to look at the size of the entire new pie.
And this brilliantly illustrates that exact trade-off. Yes, you take a roughly 20% dilution hit on your ownership percentage. That's a given. But look at the flip side here. Management's updated forward guidance expects revenue to absolutely explode. We are talking about it tripling to somewhere between $290 million and $320 million in 2026. So you're absorbing a 20% hit, sure, but you're getting it in exchange for top-line revenue that is literally multiplying by 3.
The sheer scale of this jump is honestly pretty stunning to think about. Just consider the 2025 revenue, which was sitting at $102 million. Then, boom, we step into 2026, and even the low-end guidance is sitting all the way up at $290 million, with the high end reaching $320 million. Now, to be totally fair, it is worth noting a slight expected EBITDA margin compression here, dipping from about 24% down into the 22 to 23% range. But honestly, even with that slight compression, because the new revenue base is just so incredibly massive, Kraken is still looking at generating between $65 million and $75 million in pure EBITDA. Section 3. Checking the valuation multiples and the EV to EBITDA contraction.
Now, what's really fascinating about this math is how violently the valuation actually corrects itself. Just look back at 2025 for a second. Kraken was essentially priced for perfection at a sky-high enterprise value to EBITDA multiple of 102 times. But when you plug in today's depressed stock price, along with that new massive 2026 EBITDA guidance we just talked about, that forward multiple instantly crashes back down to roughly 33 to 38 times. And here is the real kicker. 33.7 times is right on par with Kraken's historical average. So mathematically speaking, if you bought a year ago and you're currently underwater, you are actually getting significantly more earning power per share today than you were yesterday, assuming, of course, that management actually hits these targets.
To get an even clearer picture of this, we can look at the EV to EBITDA growth multiple. You can think of this kind of like a PEG ratio, but tailored specifically for EBITDA. By factoring in management's projected 39% compound annual growth rate, we find that Kraken's forward multiple sits right between 0.85 and 0.99. In valuation terms, anything right around a 1 is generally considered fairly priced. So being under 1 suggests that at 637, the stock is sitting somewhere between slightly undervalued and perfectly fairly valued today.
Section 4. 4 future stock scenarios, going from bearish lows to blue sky highs. Okay, so how do these scenarios actually play out in the real world? Let's start with the bear case. If Kraken ends up missing guidance, pulling in only $260 million in revenue and $54 million in EBITDA, well, institutional buyers are going to hold off, and those receipt holders are probably going to dump their shares in mass. That multiple would compress even further, potentially dragging the price all the way down to the $3 to $4 range. Now, moving to the base case. Say management hits the low end of their forecast, $290 million in revenue, $65 million in EBITDA. In this scenario, the market basically accepts the valuation, keeping the stock fairly priced in the $6 to $7 range, which is right about where it is now. But if we look at the bull case, they hit the high end, $320 million in revenue and $75 million in EBITDA. Here, the market rewards that flawless execution, pushing the multiple up and driving the share price nicely into the $8 to $9 range.
Let's move to our final and frankly most fascinating scenario and see how this builds, the blue sky catalyst. Because of standard accounting rules, Kraken can actually only consolidate Covelya's financials starting from the exact closing date of the deal. What that means is Covelya's entire first half of the year, which is roughly $125 million in revenue, is literally missing from Kraken's official forward guidance. It's just not there on paper. But if you mentally add that hidden $125 million back into the high-end $320 million target, you are looking at a combined full-year earning power of $445 million in revenue, which yields nearly $100 million in EBITDA. If the broader market actually prices in that true run rate, we are suddenly looking at a $10 to $11 stock.
And finally, Section 5, the big macro picture, focusing on tailwinds and upcoming catalysts.
To really figure out which of those scenarios is most likely to play out, we have to look outside the spreadsheet for a minute. What is the operational reality? Well, this newly merged entity is an absolute powerhouse. They aren't just selling tech anymore. They're actually producing their own components in-house for over 700 clients worldwide. And this is happening right at a time when Western countries are drastically surging their defense spending across the board. There's this very specific rising focus on subsea developments right now, things like mine countermeasures and underwater intelligence gathering. Plus, there is a major financial catalyst fast approaching, an expected uplist from the TSX Venture Exchange to the main TSX board by late 2026 or maybe early 2027. And look, the smart money is already positioning for this. We've seen institutional ownership quietly but steadily growing from 20% to 21.5% just recently.
So the crucial point we are left with is this. The fundamental value of the company has undoubtedly expanded, but the technical reality of millions of underwater shares is creating a heavy gravitational pull on the stock today. Will management execute flawlessly to absorb all that selling pressure and realize their true blue sky potential? Or will a near-term earnings miss shatter market confidence before they even get off the ground? The math is entirely in their favor right now, but as always, execution is absolutely everything. You'll definitely want to keep a very, very close eye on that next quarterly report.